I'll have to make a few presumptions and in front of answering that question. So the first one is going to be, I'm going to presume it's a couple, it's a
Right.
two income household,
Yeah.
and that because that's the norm.
Right.
So,
Okay.
and that doesn't mean their income is the same, right? Doesn't mean their credit rating is the same, but it's a two
Right.
income family,
Yeah. Two
and,
income family.
and they're
Perfect.
looking to purchase a home, and they want to know how much of our income should we devote to housing.
Exactly.
Well, that is such a loaded question. Let me see if I can kind of dissect it a little bit.
Yeah.
So, when you go to a financial institution, they give you a number that they think is the number that's right for you.
Right.
Their objective, the financial institution, is to loan you as much money as possible, right? That's
Yeah.
their goal. That's the
Yeah.
business that they're in. If you're credit worthy for $500,000, that's our placeholder number, then they want
Right.
you to borrow $500,000 because they've deemed that you are worthy to do so. Well, hold up. That doesn't have anything to do with what you and your significant other have discussed and want to
Right.
maybe purchase, excuse me, or have as your cost of living, because that mortgage payment is only a piece of the picture, right? If you have a loan, just purchased a home
Right.
and you have a loan, there's principal, interest, taxes, and insurance, PITI.
Right.
So the principal and interest doesn't include the taxes that are due probably within an impound account monthly, and the insurance, which is due either in an impound account or once annually. So if the bank says your mortgage payment is $2,100, but then you get the closing statement and it says your mortgage payment is $2,700, what's your first question? Where did this other $600 come from? It's
Right.
the taxes and interest, excuse me, taxes and insurance. So the mortgage payment is just a part of the story. But the underlying answer to your question is this: what is comfortable is a range of value equal to 2 to 4 times your household income.
Okay.
So you can
And
always back into to the payment amount from there.
right.
But the real issue is how comfortable do you want to be? And I know market factors are paramount because you don't have control over what prices are out there in the world.
Right.
And post COVID, real estate prices have went up so exponentially high that I know
Right.
there's people that are qualified for a loan that's 6 times their household income. I get that.
Right.
But they're doing that using a variable rate mortgage with an introductory rate, and it's going to blow up. It's going to balloon on them.
Yeah.
It's so very dangerous. Historically, 2 times household income means your mortgage payment is really low and comfortable and just super easy to handle.
Okay.
And 4 times your income is kind of a little bit of a struggle. So
Yeah.
what a younger couple will do is they'll say, we're going to go up to 4 times because we believe in ourselves and we believe our income is going to increase over
Right.
time, right? So
Right.
yeah, it's going to be, struggle bus for a minute because it's going to be we're going to really stretch and purchase something for 4 times our income. But
Yeah.
that's okay because we believe in ourselves and that our income is going to go up. But again, post COVID, 5 times income is not uncommon. But I beseech you, if you can all possibly do it, please have a fixed rate mortgage where the mortgage amount, where the interest rate doesn't change.
Right.
That will provide a lot of solace over a long period of time, where you don't have
Yeah.
to wonder about what's going to happen next on your
And,
mortgage.
and let me give an example of that, John. So basically, 2 to 4 times of your income. If you're sticking with the 2 times, right? If you're a couple making $50,000 each, your income is 100,000. That means you want to be, if you want to be on the safer side, you want to be looking for a property that's 200,000, right?
Correct.
And if you're trying to stretch it a little bit more, you think it's still okay to go up to look for a property that's 400,000, which would be 4 times of 100,000, right?
And let me tell you how I came to that conclusion. It's
Okay.
very much like oil prices. Oil
Right.
prices is so much per barrel, right? We have West Texas crude, and it's been all over the map for the last 100 years.
Hmm.
But for the majority of that time, the value of a barrel of oil is between $30 and $75. Sure, it goes outside those bounds often, but it generally comes back to between $30 and $75 per barrel.
Hmm.
So, as much as you can do 6 times your income, that really is an outlier. Like when oil gets to be $130 a barrel, that's a
Right.
big number, right? We all pay for it. We all pay for it. But hopefully, over time, it comes back to within its historic bounds. And that's 6 times income for that purchase price of a house. It's not sustainable.
Yeah.
It can be. It can be if your income goes up exponentially, right? It can. I mean, certain things can happen that make it viable, but it's going to be a struggle to at six
Yeah.
times income. And at two times income, it's easy. So people are going to say, well, that's not realistic because prices are so far outside of those bounds already.
Yeah. I was
Well,
thinking that.
so you still want to be a homeowner, right? So
Right.
I will whisper this, I can't say it loud. Maybe you do use a variable rate mortgage to stretch, but at the very first point that you can, convert it to a fixed rate mortgage.
Hmm.
So
Okay.
you just have to plan it out in advance. You say, you know what? If I can get a 3% mortgage, I could afford 5 times my income. But the only way I can get a 3% mortgage is if I use a variable rate. Okay, you need to become a homeowner because that does lend itself to more financial viability as for more financial viability, more family wealth over time. If you're a homeowner, you're generally going to have a greater net worth than those people that don't have a home. So okay, that's an entry way to get in,
Right.
but it's your first possible option. Change it to a fixed rate mortgage, and it may
Yeah.
be a few years out. That's okay, but again, you're making these decisions in advance of going to look at a home or going to look for a mortgage because you can have these discussions amongst yourself.
Yeah.